If I told you to guess which company just, grew its net income by 78% in a 9-month period, you would probably guess, a cloud software giant.
Right, or like an AI startup scaling some new subscription model.
Exactly. You certainly wouldn't guess a company that sells compact discs and vinyl records. I mean, come on.
Yeah, it sounds completely made up.
It really does. But yet, here we are. So welcome to this Talk Tickers Deep Dive. We know that as a retail investor, your time is, it's incredibly valuable.
Very valuable.
And our stated mission is always to cut through the noise of earnings season, right? To deliver you a clear, data-forward, actionable breakdown of a single earnings call in under 5 minutes.
Which we usually stick to.
Usually, yeah. But Alliance Entertainment's Q3 2026 earnings call, their ticker symbol is AENT. By the way, it just presents a financial anomaly that is so completely baffling on its surface.
A 5-minute summary just wouldn't do it justice.
No, it wouldn't. I mean, we're looking at a business model that, on paper at least, belongs in 1998.
Right, the peak of the CD era.
Exactly. Yet it's throwing off these double-digit growth metrics that rival modern tech firms. So the sources we're working from today include management's presentation, the Q&A session with analysts, and, the raw financials.
And our goal is to figure out how this supposed relic of the past is somehow outperforming the present.
So what's the real story here?
Well, what's fascinating here is that this deep dive isn't actually about a dying media business at all.
Even though that's what Wall Street assumes.
Yeah, exactly. That's the dominant narrative. But if you look closely at the underlying data in these sources, it is really a story about a structural shift.
A shift into what?
Into this high-margin ownership and scarcity economy. I mean, we're seeing a complete repricing of physical goods.
Driven by psychology, right?
Psychology, collectibles, and, frankly, a management team that has figured out how to squeeze just a disproportionate amount of profit out of a completely misunderstood sector.
Okay, let's unpack this. On Talk Tickers, we always start with the headline numbers because the data strips away the narrative.
The numbers don't lie.
Right. And the data from A&T's third quarter for fiscal year 2026 is just staggering.
Get me.
So Q3 net revenue hit $258 million.
Wow.
Yeah, that is a 21% year-over-year increase. And we really need to pause on that figure for a second.
Because it's not software.
Exactly. We aren't talking about a high-margin software product where you just flip a switch to add users.
Right. There's no zero emotional cost here.
No, we are talking about a wholesale distributor of physical entertainment media. They deal in atoms, not bits.
Yeah, they have to actually manufacture the stuff.
Manufacture it, package it, load it onto literal pallets, and ship it in trucks.
So growing top-line revenue by 21%.
To $250 million.
And a single 90-day window? I mean, that requires a massive logistical mobilization.
It's insane.
The physical reality of that revenue jump is crucial to understand here. When a software company grows 21%, their server costs might, tick up slightly.
Barely noticeable.
Right. But when a physical distributor grows 21%, it means their warehouse floors are moving significantly more tonnage.
It means their sorting algorithms, their packing lines, their freight relationships, everything is being stress tested.
Exactly. But the top-line revenue growth, as impressive as it is for this sector, is merely the setup for the actual profitability metrics.
Let's hear the profits.
So Q3 net income rose 25% to $2.3 million.
Okay.
Which translates to 5 cents per diluted share. But if you isolate just the third quarter, you actually miss the broader structural transformation.
Just where?
The year-to-date numbers. That's where the true financial engineering really reveals itself.
That is exactly where my eyes went when I was reviewing the income statement.
It's hard to miss.
Seriously. Looking at the 9 months ended March 31st, 2026, net income is up a massive 78%.
78%, that's huge.
Hitting $16.6 million or 32 cents a share. And here is the counterintuitive metric that we really need to dissect.
Let's do it.
That 78% jump in profit, it was generated on just a 5% increase in overall revenue.
That's 5%.
Yeah. So let me pitch a theory on this, and you tell me if I'm interpreting the mechanics correctly here.
Go for it.
Looking at this 78% profit jump on just 5% revenue growth, it seems like we're looking at textbook operating leverage.
Okay, yeah, keep going.
Essentially, AE&T has already paid for its massive distribution centers. Like, the warehouse rent is fixed.
Right, the building is already there.
The executive salaries are fixed. The baseline cost of running their inventory management software, that's phase two.
Exactly.
So because those sunk costs are already covered by their baseline sales, every new CD or vinyl record they sell practically falls straight to the bottom line as pure profit. Am I reading that dynamic right?
You've isolated the exact mechanism, yeah.
Yeah.
And this raises an important question. How do you optimize that leverage?
Right. How do you push it further?
Well, in any wholesale distribution business, you have your fixed costs, which you just perfectly described.
Right.
And then you have your variable costs, which are tied directly to the product.
Like what?
Like the cost of buying the actual item from the manufacturer, the cardboard shipping boxes, the packing tape, the hourly labor to physically pack the box.
Oh, sure.
So operating leverage isn't just about selling more volume. It is about ruthlessly controlling those fixed costs while simultaneously shifting your sales mix.
Shifting it toward items that carry a higher profit margin.
Exactly. Because ADT has already established this massive global logistics infrastructure, they don't need to build a new warehouse every single time demand spikes.
They just use what they have.
Right. They're pushing a more profitable mix of goods through the exact same pipes. The result is an adjusted EBITDA year to date that is up 47% to $35.7 million.
Wow. Okay. But I have to challenge the premise here a little bit.
Okay, challenge away.
Are we sure this is a flawless execution of margin expansion? Because I was looking very closely at the gross margin for the third quarter specifically.
Yeah.
It actually duped. It went down to 12.8% compared to 13.6% in the same quarter last year.
I saw that too.
Now, Amanda Necco, the CFO, she blamed that margin dip on, quote, lower margin categories scaling up.
Right.
But isn't that a massive red flag? I mean, if their entire strategy is transitioning to a high margin collectibles business, why are low margin items suddenly dominating their Q3 volume?
Dominating it to the point that it shrinks their overall quarterly margin.
Exactly. Are we sure this isn't a case of them losing pricing power and having to rely on bulk low margin sales just to hit that 21% revenue growth number? Like a grocery store selling milk at a loss just to get people in the door.
It is a totally valid concern. And honestly, it's the very first place a short seller would look to poke holes in this bullish narrative.
Because it looks bad on the surface.
Right. When you see a company growing revenue by 21%, but their gross margin is shrinking, the immediate fear is that they're buying revenue.
Meaning slashing prices.
Yeah, slashing prices or pushing cheap commoditized goods just to inflate the top line and, appease Wall Street.
So is that what they're doing?
No. The mechanics of physical distribution actually explain this anomaly.
How so?
In any given quarter, a massive wholesale distributor is going to see fluctuations based purely on the release slate of their partners.
Oh, like what the studios put out.
Exactly. If a major studio releases a massive catalog of standard DVDs, which naturally carry a lower margin
Yeah, because they aren't premium items.
Right. And if those hit retail shelves in Q3, that sheer volume will temporarily dilute the overall margin percentage.
Even though it's still bringing in absolute cash to the bottom line.
Exactly.
So you're saying the 12.8% isn't indicative of a permanent structural decline.
Not at all.
It's rather a temporary side effect of a particularly heavy release schedule for standard goods.
Precisely the opposite of a structural decline, actually. You really cannot evaluate a wholesale turnaround strategy on a single 90-day window.
Because the release slate is just too lumpy.
It's way too lumpy. You have to look at the trailing 9 months. And when you look at the 9-month year-to-date trend, gross margin didn't shrink.
It went up.
It expanded by 170 basis points. It moved from 11.6% to 13.3%.
They expanded that YTD gross margin by 170 basis points. That's wild.
It's huge.
And when you squeeze out an extra 1.7% of margin on nearly $1 billion in revenue, I mean, that falls directly to the bottom line.
It translates to tens of millions in actual cash.
Okay, so that 170 basis point expansion over 9 months proves their pricing discipline is intact.
Yes.
And their broader strategy of moving toward higher value products is actually working.
Exactly. The Q3 dip was a blip caused by product mix, not a systemic loss of pricing power. They're successfully filtering more premium products through their fixed cost infrastructure.
So they've unlocked this massive margin expansion, but, you can't squeeze blood from a stone.
What do you mean?
You can't just mandate a 13.3% gross margin on physical media if the consumer doesn't want it.
That's very true.
To pull off that kind of margin expansion, they have to be selling something people are absolutely desperate for.
Right.
Which brings us to the most baffling part of this earnings call. Here's where it gets really interesting.
I love this part.
In Q3, vinyl revenue grew 15% to $99 million.
Strong numbers.
Physical movie revenue stabilized and grew 5% to $61 million. But the data point that literally stops you in your tracks is the CD revenue.
The compact discs.
Compact disc revenue saw a staggering 90% growth to $39 million.
Let that sink in.
Let me repeat that.
Yeah.
A 90% growth in CDs in 2026. Who is buying CDs?
It sounds crazy, I know.
You have Spotify, you have Apple Music, you have every song ever recorded available in your pocket for $10 a month.
Right. The music is basically free.
Exactly. The utility of a piece of plastic that holds 74 minutes of audio is completely zero. So why is it growing at 90%?
It's because the utility of the object has fundamentally changed.
How so?
Think about it like the mechanical watch industry after the invention of the quartz movement.
Okay, the quartz crisis.
Yeah. In the 1970s, quartz watches made telling time incredibly cheap and perfectly accurate.
So mechanical watches lost their primary utility.
Exactly. They should have gone extinct, but they didn't. Instead, they transformed from functional tools into premium luxury items.
Oh, I see where you're going with this.
People don't buy a mechanical Rolex today to know what time it is, right?
No, your phone tells better time.
They buy it for the craftsmanship, the status, and the tangible connection to a legacy. And A&T is essentially experiencing the exact same phenomenon with physical media.
So consumers aren't buying CDs to put them in a Discman and listen to them on the bus?
Not at all. They're buying them as tangible merchandise.
It's a shift from utility to identity.
Exactly.
Like you don't buy a vintage, faded concert t-shirt because you need a high-performance garment to keep you warm.
Right. It's terrible at keeping you warm.
You buy it as a statement. You are investing in your fandom.
Yes.
A 16-year-old Taylor Swift fan doesn't even own a CD player, right?
Probably has never seen one.
But they will buy 4 different variant covers of her new album on CD to display on their bedroom shelf, simply to prove they are part of the community.
That's exactly it. And the source is, quote, CEO Jeff Walker making this paradigm shift incredibly clear.
What did he say?
He stated, quote, "We are not in a declining physical media business. We are in the collectible business."
The collectible business.
Yeah. When major artists drop an album, whether it's Bruno Mars, Harry Styles, or massive K-pop groups like BTS.
The K-pop fans go wild for physical media.
They really do. And they aren't just releasing audio files anymore. They are releasing a suite of physical artifacts.
Fans want the liner notes, they want the exclusive artwork, they want the lyric booklets.
Right. So streaming doesn't cannibalize physical media anymore.
Which is what everyone thought would happen.
Exactly.
Yeah.
Instead, streaming acts as a top-of-funnel marketing mechanism. It drives the superfans to buy the high-margin physical collectible.
And we live in a completely digital, ephemeral world. You don't own your digital movies. You don't really own your streaming playlists.
No, you're just renting them.
If a licensing agreement expires, your favorite album just disappears from your library. If a server goes down, your collection is gone.
It's frustrating.
It is. There seems to be a deep psychological human need to hold things, you know?
Yeah.
To own them securely in physical space. And Alliance is monetizing that psychological need.
They're monetizing it on an industrial scale. The sources actually note that U.S. vinyl sales surpassed $1 billion last year.
$1 billion.
Yeah. And in 2025 alone, Alliance sold 16.8 million units of vinyl and 13.5 million CDs.
That is a staggering amount of plastic.
It really is. And this trend isn't isolated to specialized indie music shops.
Where else is it happening?
Walker pointed out that massive retailers like Target are significantly increasing their floor space for pop culture and collectibles.
Target is giving up precious square footage for this.
Yes. And retailers like GameStop, which, used to rely entirely on selling standard video game discs.
Right.
They are seeing collectibles take up a rapidly growing share of their business model.
Yeah.
Physical retail space is incredibly expensive.
So they wouldn't do it unless it paid off.
Exactly.
Yeah.
These massive chains wouldn't be reallocating shelf space to physical media if the velocity sales didn't justify it.
And we can't really examine this physical media resurgence without digging into the logistics of Record Store Day.
Oh, Record Store Day was huge for them.
Management highlighted it as a massive driver for the quarter. Alliance shipped over 700,000 units to independent retailers just for this one event.
Incredible volume.
For a retail investor trying to understand AT&T's moat, we really have to look at how they orchestrate this. I mean, 700,000 units going out to thousands of small independent shops simultaneously.
It's a logistical nightmare.
A nightmare that AT&T has essentially monopolized.
Record Store Day is the ultimate case study in manufactured scarcity.
Okay, break that down for me.
Well, it started as a niche survival tactic for indie record stores, right?
Yeah.
Just to get people in the door.
Right.
But it has evolved into this global commercial event that thrives on exactly what Alliance is pivoting toward. People are lining up outside stores at 5 a.m.
Yeah, sleeping on the sidewalk.
They aren't doing that for access to music.
No.
They are doing it to acquire a limited edition pressing of an album that will literally never be manufactured again.
The secondary market value of these items is established the moment they cross the cash register.
Exactly. And A&T acts as the central nervous system for this entire event.
Coordinating with the record labels.
Yeah, coordinating with the labels to manufacture the exact right amount of artificial scarcity, and then physically distributing those limited units to thousands of fragmented retail locations.
Which brings us to the most illuminating anecdote from the entire earnings presentation, in my opinion.
The Handmade by Robots story.
Yes. If you want to understand exactly how A&T captures the value of this scarcity, look at their own brand, Handmade by Robots.
It's such a smart play.
They manufacture these vinyl collectible figures that look like they are knitted or crocheted, but they are actually solid vinyl.
Right.
Usually, Record Store Day is strictly about music. But Alliance leveraged their massive distribution power to get approval to release actual collectible figures alongside the vinyl.
Smart cross-selling.
Very smart. They introduced an Ozzy Osbourne figure and a Hello Kitty figure.
And the execution of this product launch is a masterclass in modern collectible economics.
Walk me through it.
They didn't just flood the market with plastic toys. They strictly capped production at 2,000 units for each figure.
That's incredibly low.
Predictably, the retailer orders came in for over 6,000 units.
So they had 3 times the demand.
Right. They intentionally undersupplied the market by a massive margin. They allocated the stores down, meaning no retailer got their full order.
Wow. Which instantly creates rabid demand at the consumer level.
Yes. Because the retailers are already telling their customers, hey, the item is severely allocated. We might not get it.
But the true stroke of genius wasn't just the production cap.
No, it was the chasers.
Exactly. Out of those 2,000 units, they skimmed 30 units of Ozzy and 30 units of Hello Kitty right off the manufacturing line.
Just 30.
Just 30. They encapsulated them, meaning putting them in hard, tamper-proof acrylic cases to keep them in pristine, uncirculated condition.
Like graded colored books.
Exactly like that. And inside that encapsulation, they embedded an NFC chip, near-field communication technology.
That technological integration is where the business model fundamentally changes.
Because it's not just a toy anymore.
No, NFC is the same technology you use when you tap your phone to pay at a coffee shop.
Right.
By embedding this chip into an acrylic case containing a pristine collectible, AT&T created a bridge between physical scarcity and digital verification.
Let's look at the financial result of that bridge, because this blows my mind.
It's crazy.
The standard Handmade by Robots figures, which retailed at normal collectible prices, hit the secondary market and immediately flipped for about $75 on eBay.
Which is a nice flip.
A very nice flip. But those 30 encapsulated NFC-authenticated units, they were trading hands for $400 to $500.
$500.
We're talking about a product that costs a few dollars to manufacture in Asia, and AT&T has figured out a way to create a market where it is valued at $500 purely through provenance, artificial scarcity, and digital authentication.
If we connect this to the bigger picture, that $500 secondary market transaction isn't just a fun story for management to tell on an earnings call.
No, it's a blueprint.
It is the proof of concept for their entire future strategy. They realized that trust, unassailable provenance, and guaranteed condition multiply the value of physical media exponentially.
Exponentially.
And management isn't content just being a middleman distributor who watches eBay flippers make all the margin.
They want a piece of that action.
Exactly. They are taking the lessons learned from those 30 Hello Kitty figures and building an entire tech-enabled platform around it.
So let's dive deep into that platform, because this is the core of management's forward-looking guidance.
The Alliance Authentic platform.
Right. They announced the launch of Alliance Authentic and the integration of a technology called N-State Authentic.
So what does that actually mean for the consumer?
This is an infrastructure rollout designed to use NFC-enabled authentication for collectibles to track provenance and resale across the entire secondary market.
It's ambitious.
Very. We need to explore the mechanics of this. How does a digital ledger actually prevent counterfeiting, and why on earth is a wholesale distributor suddenly acting like a cybersecurity firm?
To understand the value of this platform, you have to understand the biggest existential threat to the high-end collectibles market.
Which is what?
Counterfeiting and condition degradation.
Oh, okay.
If a collector buys a rare Funko Pop or a limited edition out-of-print vinyl record on the secondary market for $500, the anxiety is massive.
How do you know it's real?
Exactly. How do you know the cardboard box hasn't been opened and resealed? How do you know the vinyl wasn't pressed in some illicit factory overseas?
You really don't.
Historically, you had to rely on the reputation of the seller, or you had to send the item to a third-party grading service, wait months, and pay a hefty fee.
It creates immense friction in the market. You are dealing with anonymous sellers on the internet, and the risk of fraud suppresses the overall transaction volume and the prices people are willing to pay.
What Alliance is doing with the N-State Authentic integration removes that friction entirely by authenticating the item at the absolute point of origin.
Point of origin. Because they are the distributor.
Exactly. Because AT&T is the primary distributor, they physically possess the item before anyone else does.
Right, straight from the factory.
They take the pristine item, encapsulate it, embed the NFC chip, and tie that specific chip's unique identifier to a cryptographic digital ledger.
So it's kind of like blockchain.
It operates very similarly to blockchain verification, but it's tethered to a physical object. Anyone with a smartphone can simply tap the case.
Just tap it and that's it.
The phone instantly reads the chip, checks the digital ledger, and verifies the entire history of the object.
That's wild.
It confirms what the item is, that it originated from AT&T's authenticated supply chain, and that the encapsulation hasn't been breached.
So they are effectively building the trust infrastructure for the entire global secondary market.
Yes.
And they aren't just testing this with a few in-house vinyl figures anymore.
No, they're scaling it.
The management guidance outlines a massive expansion of this technology. They started with premium vinyl, but they are expanding the Alliance Authentic platform to include Funko Pops, high-end Steelbook DVDs, and video games for PlayStation, Xbox, and Nintendo Switch.
The video game market is a massive target for this. Factory-sealed, graded video games regularly sell for tens of thousands of dollars now.
Tens of thousands.
Easy. By integrating NFC authentication into the physical distribution of games, AT&T is positioning itself as the de facto authority on condition and provenance for the next generation of collectors.
And the catalysts to scale this platform are happening immediately.
They have a stacked pipeline.
The earnings call provided a real roadmap for the back half of the year, highlighting massive upcoming product releases that will flow right through their distribution network.
And the biggest one.
The most significant catalyst identified is the release of Grand Theft Auto 6 in Q4.
GTA 6.
We really need to contextualize the sheer scale of this product. GTA 6 is arguably the most anticipated single entertainment product in human history.
I don't think that's an overstatement.
It's not. The previous iteration of the game has sold roughly 200 million copies over its lifespan.
200 million.
AT&T is perfectly positioned to capitalize on this because they have a direct purchasing relationship with Take-Two Interactive, the game's publisher.
The logistics of a release like GTA 6 are staggering. Take-Two will rely heavily on AT&T's global warehouse infrastructure to physically distribute millions of copies of the game simultaneously.
They have to hit a unified global release date.
Right. But the pure distribution of the game disc is only one facet of the revenue opportunity here.
What else is there?
The earnings call revealed that there is a highly anticipated 20-plus song vinyl soundtrack being released alongside the game.
Oh, this highlights the incredible cross-selling synergy of their business model.
It perfectly ties it all together.
They distribute the massive hit video game to specialized gaming stores like GameStop, right?
Yeah.
But they simultaneously distribute the highly collectible, high-margin vinyl soundtrack to independent record stores.
And they distribute both items to massive big box retailers like Target.
So they are capturing multiple distinct revenue streams from a single cultural event, utilizing the exact same logistics network.
Furthermore, before we even reach the Q4 GTA 6 launch, management highlighted a massive catalyst in August.
The Amazon deal.
Yes. AENT has secured a partnership with Amazon MGM Studios to release the breakout box office hit Project Hail Mary on DVD and premium physical formats.
Jeff Walker explicitly called it the biggest theatrical release they've had in their pipeline for 2025 and 2026.
Which raises the question of physical movie distribution. Earlier, we noted that physical movie revenue grew 5% to $61 million.
Right, we touched on that.
Why is a format that is universally considered dead actually growing?
See, because the format is premiumizing.
Exactly.
The industry data provided in the sources indicates that 4K Ultra HD formats grew by approximately 12% in 2025.
12% growth for physical movies.
Because people who genuinely love cinema do not want to watch their favorite films subjected to the aggressive compression algorithms and bandwidth throttling of streaming services.
It ruins the picture quality.
It really does. They want the uncompressed audio and the pristine visual fidelity of a 4K disc,
Often packaged in a limited edition, highly collectible steelbook case.
which they can then authenticate with an NFC chip.
Exactly. And through their new direct license agreements with studios like Paramount and MGM, Alliance has secured direct access to distribute these massive film franchises in these premium formats.
But executing on these massive distribution deals requires immense capital.
Oh, absolutely.
You cannot just call up a major Hollywood studio and demand 1 million copies of a blockbuster release without the cash reserves to finance the inventory acquisition.
This is where their balance sheet strength becomes their ultimate weapon.
They have a lot of cash.
During the call, CFO Amanda Necco emphasized their liquidity position. They have $60 million in working capital and $56 million in available liquidity on the revolving credit facility.
Wow.
In the distribution business, cash is king, and AENT is sitting on a war chest.
That $56 million in liquidity provides a massive strategic advantage.
It guarantees they can fund the massive inventory bills required for exclusive partnerships like the Project Hail Mary release or the GTA 6 launch without stressing their daily operations.
But even more critically, it provides the capital necessary to aggressively pursue M&A mergers and acquisitions.
Yes. During the Q&A portion of the call, an analyst specifically asked about their strategy for acquiring more owned brands like Handmade by Robots.
What was the response?
The response from CEO Jeff Walker was incredibly aggressive. He practically gave out his personal contact information on the call.
Really?
Yeah, publicly urging anyone with acquisition leads to bring them forward. He made it unequivocally clear that they are actively seeking M&A opportunities for licensed products.
It is a brilliant roll-up strategy tailored for wholesale economics.
How so?
They are looking to acquire small, specialized, collectible companies that make unique, high-margin items.
Well,
If they buy a boutique collectible manufacturer that currently generates, say, $3 million a year through its own limited channels, they can instantly plug that company's products into Alliance's massive global distribution network.
I see.
By pushing those same products through their established relationships with thousands of independent record stores, massive chains like Target and GameStop, and international distribution channels, they can multiply that acquired revenue exponentially overnight.
It's an instant force multiplier.
Exactly. So what does this all mean? We've dissected the headline financials, we've analyzed the underlying shift in consumer psychology from utility to collectability, we've explored the mechanics of their NFC authentication platform, and we've laid out the massive future catalysts.
We've covered a lot of ground.
We really have. It's time for the bottom line. As a retail investor analyzing this data, how should we value ticker AENT?
Well, to accurately value AENT, you have to examine the prevailing bear thesis and determine if it survives contact with the data from this earnings call.
And the bear thesis is what?
The bear thesis surrounding AENT for years has been simplistic physical media is a melting ice cube.
Right.
The narrative argues that streaming is ubiquitous, physical discs are dead, and therefore any company relying on their distribution is destined for bankruptcy.
And based on the rigorous breakdown of these sources, I am taking a definitively bullish position today.
Really, definitively bullish.
Yes, because this earnings call completely obliterates that melting ice cube theory. The turnaround is undeniably working.
The numbers back that up.
They do. The fundamental nature of physical media has evolved. It is no longer a low-margin utility. It is transformed into high-margin pop culture collectibles driven by intense consumer fandom.
The empirical data entirely supports that bullish stance. You cannot fake a 78% year-to-date jump in net income on a mere 5% revenue growth.
No, you can't.
That metric alone proves management strategy is executing flawlessly. They're not simply surviving a decline.
They are thriving.
They are wringing massive profitability out of their existing fixed infrastructure through intense operating leverage and a disciplined pivot to premium, scarce goods.
So for the retail investor tuning in, here is the actionable advice derived from this deep dive.
What should they do?
If you are currently holding shares of A&T, the fundamental data suggests this is a stronghold. Management is successfully executing their operating leverage strategy.
They are strictly managing their fixed costs.
Yes, and they are actively shifting their product mix to higher margins, and their balance sheet is highly liquid. The core business is generating real, sustainable, and growing cash flow.
And if you are a potential buyer considering initiating a position in A&T, your strategy should be focused on monitoring the execution of the back half of the year.
The catalysts.
Exactly. The Project Hail Mary release in August and the massive Grand Theft Auto 6 ecosystem in Q4 are immediate, quantifiable revenue catalysts that will test their distribution capacity.
And what about the M&A?
Keep a very close eye out for press releases regarding new M&A activity or new studio partners joining the Alliance Authentic NFC platform.
Why are those so important?
Those announcements will be the primary leading indicators that their transition from a traditional distributor to a tech-enabled platform is actually taking hold in the broader market.
This has been an incredibly exhaustive deep dive into the source material.
We covered a lot today.
We did. We set out to cut through the noise. And while we definitely blew past our standard 5-minute format, I think the complexity and profitability of A&T's structural pivot demanded this level of scrutiny.
It absolutely did.
Thank you for tuning in to this Talk Tickers Deep Dive. You are now armed with the most important data and the underlying mechanics from Alliance Entertainment's Q3 call.
But before you go, we want to leave you with one final provocative thought to mull over.
Lay it on us.
Management heavily emphasized that their new NFC authentication chips are designed to track the full lifecycle of a collectible.
The full life cycle, meaning from the exact moment it's encapsulated in their warehouse to the first retail sale to every subsequent time it is sold and resold on the secondary market.
Exactly. So consider the ultimate endgame of this technology. If AE&T successfully maps the global secondary market for these rare items using their digital ledgers and NFC chips,
could they eventually transition from being a one-time wholesale distributor into something resembling a software company?
Right. Could they rewrite the fundamental rules of physical retail by embedding smart contracts that take a digital royalty cut?
Like a microscopic transaction fee.
Exactly. A tiny fee every single time a vinyl record or an encapsulated figure changes hands on eBay or StockX decades from now.
Wow. If they can crack that code and actually monetize the perpetual resale of physical goods.
They aren't just selling CDs anymore.
No, they're literally minting their own future. Thanks for listening. We'll catch you on the next deep dive.